Hey, it's Jim, and this is level 1 of the CFA program, the topic on quantitative methods, and the learning module on the time value of money. This is part 2. Recall that in part 1, we only covered one LOS, and that took us about an hour, right? So we have about 25 or 30 slides here. I promise I won't keep you that long for these second two LOSs, but I want you to look carefully at the second one. We're going to do the same thing that we did in the first LOS, calculate and interpret, but this is a combination of what we did in the previous learning module and then what we just did in part 1. Recall in part 1 when we were solving for present value, when we were solving for the present value or the price of a bond, when we were solving for the present value or the price of a share of stock, we were given that required rate of return. Well, the second LOS, we're going to use the same models that we just did, but we're going to solve for the interest rate. The Institute calls that an implied return. And then in the last LOS, we're going to go ahead and talk about forward contracts and option contracts. And that'll be a really, really good way to end this beginning series of learning modules. All right, so there's a definition for implied return, a return based on the current price, right? So think about what we just did. We saw for the price of a bond, we saw for the price of a share of stock. That was a theoretical price. But what we can do is we can go ahead and look on the floor of the New York Stock Exchange or look on a bond exchange, and we can see the price. And then we can estimate those future cash flows, and then we can go ahead and compute what's known as an implied return. We're also going to calculate a growth rate and a couple of other rates as we go forward. So let's go ahead and go back to that very simple zero coupon fixed income security where we paid a discount amount for it today, say $97, and then in a year we got $100, right? A zero coupon bond. There was no coupon or interest payments in between the purchase of the bond and the maturity date of the bond. And so you can look at those equations down there at the bottom of the page, and essentially they're just kind of rearranged versions of what we did back in the part 1. But once again, we're going to go ahead and use our financial calculator. So let's do it the long way here. Zero coupon bond with a price of $900. So remember what I said to you in part 1. Look, when you're given a price of $900, then you automatically assume that the future value or the maturity value of the bond is $1,000. Now in this example, it's given to you right in the next part of that sentence, but it doesn't have to be given to you. So if the question stem read, the bond price is $90, well, then you would know that the future value is $100. All right, 5 years. What is the implied annualized return? The Institute could also say, what is the yield to maturity on this zero coupon bond? What is the required return on this zero coupon bond? And this is really just an F over P minus 1, future value of 1,000, present value of 900, F over P. Now we have to raise it, right? So this is a 5-year period, so we need to chop it. Remember we did a little bit of this back in part 1 and in the previous learning module. We just chop it into 5 parts. So your natural instinct is just to divide by 5, but mathematically we need to raise it to the 1/5. So it's F over P raised to the 1/5, and we have to subtract out the 1, right, to get rid of the compounding thing. So there you go, 2.13%. And of course, we can do this in our financial calculator. So let me get mine up here just to make sure you can do this. And there is a little trick here. So there's my 3334 from our part 1. So let me clear that out. All right, so what are we going to do here? We're going to make 5N. We're going to make zero payment, right? It's a zero coupon bond. We're going to make 1,000 as future value. And then we need to enter something for present value. Now remember back in part 1 when we did that very first example with the calculator, we did 100 as present value, solve for future value, 10% 1 year. Remember we got a minus 110? And I said to you, the calculator doesn't care whether you are the borrower or the lender. Well, here's a really good example of that application of what I was saying previously. In order to solve for the interest rate, you need to make either present value or future value negative. Now, there are going to be problems in the future where when solving for the interest rate, we're going to have to make present value negative. So I want you to get out your pencil right now and I want you to write this down. I'll say this multiple times in level 1. You ready for this? When solving for an interest rate, comma, make present value negative. You got that? You got that? Because if you don't, the calculator, depending on which one you have, may give you a no solution or an error. So let's go in here and we need to do, I need to take my glasses off so I can see. So we need to do 900 for present value. And you don't want to make it negative by using the minus sign. You want to hit the plus minus button. So make that present value and then compute I. And there you go, 2.1296. Now for coupon paying bonds, it's the exact same process, but remember back here, we hit 0 for payment. Well, what are we going to do? What are we going to do now? We're going to hit whatever the coupon payment is, and we're going to solve using that same process. But for those of you who are visual and like to see what we're trying to solve for, look at that equation right above the green box. So there's the price, there's the present value of a coupon bond over on the left-hand side. Suppose that's $950 or something. And then the coupon payment in the numerator, suppose it's $55, and then FV over there at the far right, that's $1,000. So all we're doing is we're solving for the yield to maturity on a bond. We're solving for the interest rate. What does the Institute call this? The implied rate of return. Now, remember back in the very first learning module where we were doing geometric returns and internal rate of return, that R down at the bottom is actually an internal rate of return. So you could solve this using the IRR button on your calculator, but it's a little bit easier to use your 5-time value of money buttons. All right, you ready? Here we have a bond 7 years ago. Face value of 1,000 and a 20-year maturity. All right, so this is a really super interesting question. Note, it was a 20-year bond when it was issued 7 years ago. The current bond is trading at 11.20. Oh, wait a minute. I don't think we've talked about this yet, right? We've said that when bonds have prices that are less than their par value, less than $1,000, we call that a bond that sells at a discount. Well, there are bonds that can sell for premiums. Here we have one of those cases. Bond is trading for 11.20, so it sells at a premium. And the distinguishing factor that determines whether the bond sells at a premium or a discount is the relationship between the coupon rate and the yield to maturity on the bond. If the yield to maturity is higher than the coupon rate, then the bond will sell at a discount and vice versa. All right, so what could we do? Well, hold on. What we could do is we could come back here and we could guess. We could throw in an R in the denominator and work this out in our calculator. And if the present value turns out to be, what was that number here? 11.20, well, then we know we guessed right. But how many times are we going to guess right, especially on a CFA exam? The answer is never. So let's go ahead and get out our calculator. So let me clear that out. So what was I saying just a moment ago? It was a 20-year bond when it was issued 7 years ago. So the time remaining until the bond matures is 13. So remember, we're going to put 13 in there for N because that's how many more coupon payments that the bondholder is going to receive. Now, just a word of caution. You know, of course, that on a multiple choice question on the exam, the Institute is going to have answer A with an N of 7, answer B with an N of 13, and answer C with an N of 20. So make certain that you put 13 in there for your N. So I'll do 13 is N, and 1120, make that negative. I take my glasses off so I can see what I'm doing. What is that? That's present value. What's our coupon payment? Oh, what were we told in that previous slide? 6%. So 6% of 1,000 is $60. There's payment. and a future value of 1,000. And so what am I doing? Compute I, there we go, 474. There we go. Isn't that beautiful? All right, so what did we just do? We solved for the yield to maturity on a zero coupon bond. We solved for the yield to maturity on a coupon paying bond. We used our 5 time value of money buttons, but all we did was solve for the I/Y on our calculator, which of course is the yield to maturity on the bond. It's the required return on the bond. And by the way, it may sound like I'm repeating myself and emphasizing these concepts and terms over and over again, but the quicker that you get them embedded in your brain, the more successful that you will be. All right, so now what are we going to do? We're going to say, all right, we solve for the yield on a bond. Let's solve for the required return on a share of stock. Let's solve for the growth rate on a share of stock. So we're going to go ahead and use our model that was introduced back in part 1. I'm going to go ahead and pause, and I'm going to ask you a question. Who's the dude's name that came up with this model? Oh, of course, it was, I'm hoping that you universally said Myron Gordon. Notice we need 3 input variables. We need a dividend, we need a required return, and we need a growth rate. We use those 3 inputs to solve for the price, the present value of the share of stock. Well, now all we're going to do is rearrange this equation so that we solve for R. All right, so here's the implied return. So R is equal to, skip over to the far right equal sign there, to the right of that equal sign. So what do we've got? We've got the dividend 1 year from today, right? T plus 1, T is 0, divided by the present value, which is the price of the bond, plus a growth rate. Now, that dividend divided by the present value, that has an important connotation to it. It's known as the share of stock's dividend yield. Dividend divided by the price is the dividend yield. And that growth rate, the plus G, some people say that that kind of captures the capital gain associated with with buying a share of stock. I'm okay with thinking it that way. So what does that implied return mean? That if you buy a share of stock from Procter & Gamble, what are you going to demand? You're going to demand a dividend yield and a capital gain. So this Myron Gordon growth model does a really great job of dividing those 2 components of the investment outcomes of a share of stock. Now, what we can do down at the bottom is rearrange the formula again to get an equation for the growth rate. Let's go ahead and work on an example. Let's suppose we have a stock that's trading at $150 with an annualized expected year 1 dividend per share of $2. We have an analyst that projects that the dividends will grow at 5% per year. So required return expected by investors, or the implied return by the Gordon growth model. All we're going to do is put the $2 in the numerator. That's the year 1 dividend, okay? T plus 1, year 1 dividend, divided by the current price, which of course we know, right? It's given to us in the problem. But we can easily go to the floor of the New York Stock Exchange and observe that number. And then we're going to add that 5%. Let me just caution you once again, whenever you use in the Myron Gordon growth model, you need to use the decimal form of the interest rate. So add 0.05, so you get 6.33%. Let's go ahead and extend this conversation to a price earnings ratio. This is going to be super important as we move through the rest of level 1 and 2 and 3. Lots and lots of analysts like to use the PE ratio to kind of compare valuations between and among different companies. So what is the PE ratio? It's just the stock price in the numerator divided by earnings. So if we have a PE ratio of, let's say, 10, what does that mean? 10 in the numerator divided by 1 in the denominator. That means that for every $1 in earnings that the company is generating, the traders on the floor of the New York Stock Exchange are willing to pay $10 for that $1 in earnings. So think about what that means. Suppose you're comparing that company with another company that has a PE ratio of 25. Wow. For $1 of earnings, we have to pay $25 on the floor of the New York Stock Exchange. So price earnings ratio is a relative measure of valuation. It's going to be super important for us to try to determine which stocks are overvalued and which stocks are undervalued. Notice that second arrow point there. Investors and analysts use to determine relative value of a company. This is what I just said. That should make sense. Now, the question then that you should be asking is, all right, what does this have to do with the Myron-Gordon growth model? Well, what we can do is, if in fact on the left-hand side of the equal sign, there is the present value, which is the price of a share of stock. Now, granted, it's the theoretical price. What we can do is divide that by E, the earnings per share, and then we can go over on the other side of the equal sign and divide the dividends by E. Right? When did we learn this? Kindergarten, first grade, third grade, fifth grade, that when you divide both sides of an equal sign by the same number or the same variable, you do nothing to the equality. So that's really all we're doing. We're dividing both sides by the equal sign, and therefore the Myron-Gordon growth model looks like that in the gray box. So what we can do is we can combine dividends, growth rate, and earnings per share and required rates of return into the model to determine relative valuation. Now, what we can do is we can go ahead and look at the current PE ratio based on current dividends and current prices. But it's even more appropriate as a good analyst to look at a forward PE ratio. So notice that first block point up there, which is based on a projection of the company's earnings per share. All right, so what are we doing as good financial analysts? We're evaluating the corporation and we're saying, okay, this corporation is pretty good. It's generating this much cash. It has this much leverage. It has these kinds of ratios. Therefore, based on all of this analysis, I'm going to predict what that earnings is going to be at some time in the future. And so this is really all what a forward PE ratio is. And so notice we have in green box over there the expected payout ratio. So instead of the current payout ratio, which is current dividends divided by current earnings, we just substitute the T+1 subscript in there. Everybody see that in the two green boxes? So look at the bottom box down there. Forward PE ratio is positively related to higher expected dividend payout ratios. Oh, wow. This makes a lot of sense. And it's growth, but it's negatively related to the required return. So what was I saying just a moment ago? Throwing this earnings, whether it's current earnings or expected earnings, like in these two in the bottom green box there, it gives us a better understanding of the interworkings of those variables. All right, here we go. Company has a forward PE ratio of 15, and it has a dividend payout ratio of 40%, required return of 10. Let's go ahead and solve for the dividend growth. So we just use this formula right there, rearrange it to solve for G, and if you do the math there quickly, you get 7.33%. All right, moving on to the last and third LOS in this learning module. Let's talk about cash flow additivity principle. Oh, this sounds like a super complex idea, but it's really not. I want you to think about this timeline. Suppose that in a timeline, we have time period 0, and then we have time period 1 and 2 and 3. Are you ready for this? This is the example I give my students all the time, and it works pretty well. So suppose that I decide to pay you 1 apple in year 1, 1 peach in year 2, and 1 kiwi in year 3. All right, so you take the present value of those fruits. Now, can you say I'm giving you 3 apples or 3 kiwi or 3 peach? No, you can't say that. So what this additivity principle tells us is that when we take the present value of, let's say let's say that the apple is $100. Let's say that the peach is $100. Let's say the kiwi is $100. Well, we know that because of time value of money, that each of those $100 are not equal because of the idea of compounding and discounting. But what we can do is we can take the present value. We can swing the apple back 1 period. We can swing the peach back 2 periods. We can swing the kiwi back 3 periods. And because they are, notice what we have in bolded there. This is what the Institute says, indexed at the same point, you can just sum those. So you can sum the fruits when they're in time period 0 if they are indeed in terms of present value. You can't sum the 100 and the 100 and the 100 and get 300 because that violates the time value of money principles. Oh, pause. Unless, of course, interest rates are 0%. If interest rates are 0%, then you can throw all the fruit in there that you want and it still comes out. Well, I don't really know what it comes out, but you get the idea. Look at the second arrow point. This cash flow additivity ensures that market prices reflect the condition of no arbitrage. All right, so here's a really cool concept that we'll talk about till the very, very end of level 3. Arbitrage means that you have an investment opportunity that requires no capital on your own part, no initial investment, no risk, but a positive expected return. Oh, doesn't that sound like this is something that we want to learn about? All right, let's take an example here. We have 2 zero coupon bonds. Bond A has a maturity of 2 years and a yield of 2%, while Bond B has a maturity of 4 years and a yield of 3%. A risk-neutral investor has $1,000 to invest. Oh, I love the way the Institute just slips in this concept of a risk-neutral investor. In fact, in this learning module, it just tells you about a risk-neutral investor and doesn't really explain it. But I'll go ahead and give you kind of my 2 cents of this introduction of a risk-neutral investor. It's exactly what the name suggests, that a risk-neutral investor simply looks at the return on an investment and ignores risk. Now, you might think that's kind of a strange way to price zero coupon bonds. And at first glance, it probably is, because we know that investors are risk averse. However, when we move into learning modules on derivative securities and bonds that have embedded options in them, we're going to need this risk-neutral investor to help us come up with a no arbitrage price. So for now, let's just take a step back and say, okay, a risk-neutral investor, this is some person who's just out there who doesn't care about risk, who only cares about return. And let's put a period there, but right after the period, there's a comma, and we know there's going to be more things. I'm not sure what that means grammatically when you have a comma followed, or a period followed by a comma. All right, so we have 2 choices here down at the bottom. We have option 1 on the left and option 2 on the right. So what could we do? We could invest in Bond B. And what do we know? We're going to get 3% every year for 4 years. So what's our future value? Well, that's a super simple calculation down there. 1125.51. Option 2, on the other hand, we could buy Bond A. But Bond A matures in 2 years. So to make these 2 choices equivalent, what we're going to have to do is in 2 years, we're going to have to find another 2-year zero coupon bond so that we can match 4 years of maturity. So how do we calculate that future value? Well, we're going to do it the same way. So look at the bottom there. We've got future value is equal to present value. So we have 1,000. 1 plus R, all right, so that's that, what was Bond A? 2%, so 1.02 in there. But then we need to compound it out by using something that's known as a forward rate. So this forward rate is going to be some expected future interest rate that we think is going to be in place. Now, of course, for option 1 and option 2, for an investor to be indifferent between these 2 options, that future value has to come out to 1125.51. So we can use our equation and solve for that forward rate. So look down in the third box. So what are we doing? 1125.51. We're forcing that future value to equal, there's my 1,000, there's the 1.02. Don't forget to raise it to the 2 power because it's 2 years. And then what is that forward rate? So we need to go ahead. Well, we'll do some algebra there. So look at the bottom arrow point. Ensures that there is no potential for risk-free profits and maintaining market efficiency. What did we do here? In my previous example, we did cash flow additivity with the apples and the peaches and the kiwi. We did that in present value. Here, we did it in future value. So let me go back here real quick. What was that phrase that the Institute used? Indexed at the same point. So it could be at time period 0, like it was in my example. It could be at time period 4, like it was in that example. It could be at time period 2, or time period 18, or time period 4 million. Whatever that is, cash flow additivity simply means that if you have cash flows in one period, go ahead and sum them. All right, this is beautiful stuff here because the Institute used to wait a super long time to introduce the concept of options. But now it does it here in one of these early learning modules. And I think that's great. The earlier you learn about options and option pricing, the better chance you have of success for passing all of the exams. What we're going to do here is we're going to use this cash flow additivity concept to determine the price of an option. So let's go ahead and talk about a simple option pricing. All right, you ready for this? Let's start with an option contract. It gives the owner the right, but not the obligation. And that is so important. Go ahead and circle those things on your slide deck or in your notes. You have the right, but you are not obligated to trade. That means that you have the right to do something, but you also have the right to do nothing. And that right to do nothing has tremendous value, as we'll see throughout the program. So an option gives the right, but not the obligation, to either buy or sell an underlying asset, like a share of stock. Now, if the option gives you the right to buy a share of stock, that's known as a call option. If the option gives you the right to sell a share of stock, that gives you a put option. So let's look at a quick example down here. So let's suppose we have a share of stock. There's time period 0. Share of stock is $100. What we're going to say is that of all of the possibilities that could happen in 1 year, we're going to say this stock has 2 chances. It can go up to 130 or it can go down to 85. This is known as a binomial model. We have only 2 choices. So forget about all of the other choices. Like, we know if you buy a share of stock today for 100, you might sell it for 200 or 185 or 162 or 75 or $0, right? But this model is going to restrict us to 2 possibilities. So the stock price today is 100. The stock price a year from now could be 130. Notice the superscript is a U. If the stock goes up in time period 1, it's 130. If the stock goes down, there's the superscript D. It goes down to 85. All right, so how can we use this cash flow additivity and our recent expertise on call options? All right, look at that first block. Let's suppose that we want to sell a call on that stock that gives the buyer the right but not the obligation to purchase the asset for $120. All right, so let's just think about this. So what this option does, it gives the buyer the right but not the obligation to buy at 120. So let's go back here real quick. So think about it. Let's suppose you're the buyer of this option. I'm the seller of this option. Let's forget who you are and let's forget who I am here for just a second. I'm just a regular old investor. And I sell you the right to buy this share at 120. Well, if the stock goes up to $130, this is great news for you, right? You get to buy it from me for 120. And then you go to the New York Stock Exchange and sell it for 130. This is called an in-the-money option. Wow, that's awesome. But what if the price goes down to $85? Well, there's no way you're going to pay me 120 because you can go to the New York Stock Exchange and buy for 85. So what happens here? If the stock price goes up, then a year from now, that option is worth $10 to you, right? 130 minus 120 equals 10. Now, what we can do is we can go ahead and take a look at this and say something like, oh, wait a minute. How much are we going to pay for that option today, right? I'm selling you the option. How much are you going to pay me for that option? Oh my gosh, we're going to have tremendous conversations going forward about call option pricing. We're going to do something called the Black-Scholes-Merton option pricing model. And I promise you, after that recording, you're going to get out of your chair and do cartwheels around your room. But that's a conversation for another day. So let's go ahead and remind ourselves about this concept of no arbitrage. And let me introduce a risk-free portfolio. Look at that 4th box point. Suppose that we sell this call option. Remember, I'm selling it to you. I'm selling you the right but not the obligation to buy this share of stock from me. Now, when I sell you that option, do I own the shares of stock? I might, but I might not. But in this case, in order to craft a risk-free portfolio, let's suppose that I buy 0.22 units of the underlying asset. Now, you should scratch your head and say, okay, Jim, where did you get the 0.22? Trust me when I say we got the 0.22 from some math. We'll worry about that some math some other day. So just confirm that that number was not just made up. All right. So this risk-free portfolio is going to look like this. I'm going to buy 0.22 units of a share of stock that sells at $100, right? That was from the previous slide. And then I subtract out the call price, right? All right. So think about this risk-free portfolio. So I'm owning the stock and I'm writing the call option. I'm selling the call option. Did I say that earlier? Writing the option and selling the option, they mean the same thing. This is called a replicating portfolio, which relies on this notion of cash flow additivity. All right, so you ready for this? So what happens? If the stock price goes up, then I own 0.22 units. And don't worry about owning a fraction of a share of stock. Just assume that we can own fractions of shares. So 0.22 times that rise in price to 130 minus the $10 that I have to pay you, right? You bought the call option, and after a year, when the price went up to 130, you made $10, right? So that's $18.89. Now, if the stock price goes down to $85, well, 0.22 times 85 minus 0, because the option expires worthless, right? You're not going to pay me 120 when the price is 85. Well, there's the 18.89. So look at the bottom of the timeline here at time period T minus 1. What do we know? The value of this portfolio is going to be worth either $18.89 if the stock price goes up, or $18.89 if the stock price goes down. Those are expected future cash flows. So why don't we go ahead and discount them? Why don't we take their present value? So all we're going to do is we're going to use that equation. Look down at the bottom, the value of CO, that's the value of the call option. And oh, by the way, we're going to assume a risk-free rate of interest in there. So you throw that in. So what are we doing? The present value, 1889, is 1843. So what do we know? All I'm going to do is I'm going to take 22.22 number of shares, fraction of shares times the $100. I'm going to equate that to the 1843. That's the present value. You get the sense here? Cash flow additivity. And then I'm just going to solve for the call price over there, C sub 0. So there we go. The fair value, the fair price of a call option is $3.57. So think about what this means. And this is super important going forward. I'm not quite sure if this is important in its addressing of the LOS, but look, when I sell you that call option, you're going to pay me $3.57. That's the price of this call option. Now, how about if we do one last thing here? Forward exchange rates using no arbitrage. So we can do this with currencies. Now, remember, we haven't learned this yet, but currencies really are just can be exchanged for other currencies. And so an exchange rate is just the value of one currency in terms of the value of another currency. So let's look at this quick example down at the bottom. We have $2,000. We want to invest it for 3 months. What we can do is we can invest in U.S. government debt or German government debt. Oh, my goodness gracious. All right, so you ready for this? So what are we going to do? If we invest in U.S. and we have a risk-free rate of interest, notice we say a U.S. Treasury bill. We'll learn all about Treasury bills and Treasury notes and Treasury bonds. But let's just suppose that that is a risk-free rate of 3%. And by the way, most people think that the U.S. Treasury Department can issue risk-free securities. So after 3 months, what do we know about future value? Well, we've done this calculation multiple times already. So there you get 2015 US dollars. Now, investing in the German government debt, this is a little bit more complex because what we need to do is start with the 2,000 US dollars and convert over to euros. So there's an exchange rate there. See the third, what is that? The third arrow point? 1 US dollar is equal to 0.92 euros. So what that translates into, we're going to take the 2,000 US dollars and we're going to get 1840 of euros. We're going to invest in German government bonds. Suppose that the yield on those German bonds is 6%. So you just do the math there. Of course, at maturity, you're going to want to convert those euros back into US dollars. Now, what you can do, let's pause here. This has nothing to do with the LOS. What you can do is you can just wait and convert those future euros at the exchange rate, which will be present in 3 months. That exposes you to currency risk. Or today, you can enter what's known as a forward contract. You can just go down to the bank and say, hey, I want to sell 1840 euros in 3 months' time for US dollars. And the bank might say, look at the bottom there, oh, there's the exchange rate. Well, if you sign that forward contract and you convert those euros back, you'll get the 2015. So both of those choices give you the same amount of money after 3 months. So do you get the sense here that this cash flow additivity, as it applies to investment in domestic and global fixed income securities, or option pricing, this cash flow additivity thing, is super critical? All right, it took us a while to get through all of those LOSs, but we did. There were 3 of them, and this was a great introduction. So what did we do in the previous learning module? We talked about interest rates. Here, we've talked about present values, implied rates, and then cash flow additivity principle. So what I want you to do now is I want you to take about 40 minutes, go to the end of this learning module, and I want you to work through all of those problems. Some you'll need your calculator for, some that you won't, but pay close attention. This is my contention, that if the Institute puts a problem at the end of one of its learning modules, that means to me that it's attaching a little bit additional significance to that type of a problem. Remember, the learning module, there's probably 100 problems that we worked through. However, focus on those at the end of the learning module. So hey, thanks for watching. Have a great day and good luck studying.